Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 116. My name is Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. And by night, I write the Best Interest blog and I host this podcast. I help busy professionals and retirees avoid mistakes and grow their wealth by simplifying their investing, taxes, and retirement. Later today, I'll be joined by Hanna Horvath. Hanna is a certified financial planner. She's the managing editor at Bankrate, and she's the author of Your Brain on Money, a newsletter she writes. We're going to talk today, Hanna and I, about, well, your brains and money, the psychology, financial psychology, and some similar related topics. But before Hanna joins us, we have some customary preamble, some thoughts from yours truly. And of course, we start today with a review of the week from JCern89, who writes in and says, "Great perspective on personal finance. I came across Jesse on the Stacking Benjamin show, and I thought his views were engaging enough to give his podcast a try, and I was not disappointed. Jesse has a talent for explaining things in a way that is both simple and relatable, but that also adds a level of detail that goes just a little beyond what I hear from the others in this space. His explanations of his thought process really add the why on top of the what. His AMA episodes are world-class. Keep it up." Well, Jay Cern, thank you very much for the kind words. I'd be happy to send you a super soft podcast t-shirt. You can drop me an email to jesse@bestinterest.blog and I will get you hooked up. And listeners, if you have a question, a concern, or feedback that I can answer or address, especially for a future Ask Me Anything episode, send those questions to my email address, jesse@bestinterest.blog. And now, before Hanna tells us more about our brains on money today, I wanted to share from 3 money psychology articles I've written over the past few years. The first of those articles is called Chasing the Fad. I started the article, I posted a picture of a specific Google Google search term. You can see how often people are searching various things on Google. And this particular term, no one had ever searched for it, basically, until 2017. And then it saw a massive spike, becoming one of the most searched for terms over a very short period of time. Since then, it's basically disappeared. And some of you might not even remember this. It's been 8 years or so. It was plastic. It was a toy. It spun around in circles and little kids were playing with them. It was fidget spinners. I don't know if you remember fidget spinners. Definitely a fad of the day for young kids, pre-teenagers probably in 2017. But by proxy, their parents and the rest of us found out about these things too. A very simple toy, this 3-lobed kind of plastic structure that sat on a ball bearing, and it would just spin and spin and spin and spin. And it seemed like every kid had at least a couple in their backpacks in 2017. But why, right? Why did fidget spinners go viral? Why does anything go viral, I suppose? Where do these school fads come from? And as a bystander, and I certainly found myself as a bystander for fidget spinners, they seem to crop up out of nowhere. I looked at them and thought, that's so stupid. What a dumb toy. But when you ask the experts, well, to be honest with you, they somewhat agree. Behavioral engineer Nir Eyal wrote, "If you take a product like the fidget spinner, there's no good reason why people should like them other than the fact that they see other people liking them, and that gives them value. So once a few kids start bringing fidget spinners into class, other kids want to know what these things are. Even though they are just a piece of cheap plastic, the fact that some kids are getting really into them and won't let other kids play with them, it increases the value of the product through mimetic desire." So that term right there, mimetic desire, social scientist René Girard, I think, he looks French to me, it was his magnum opus, Mimetic Desire, which states that man is the creature who does not know what to desire, and he turns to others in order to make up his mind. We desire what others desire because we imitate their desires. It's follow the leader, it's copycat, it's Simon Says, it's go with the crowd. It's this innate primal jealousy. And we've all succumbed to it at some point in our life. Most likely, we've been unwittingly influenced by others. Humans like stuff because we see other people liking that stuff too. And school fads are a textbook example of mimetic desire. Any parents who have asked, why in the world is my kid doing insert irrational behavior here? They can likely find their answer somewhere within mimetic desire. Anyone looking back on their yearbook wondering, what the hell was I thinking in that yearbook photo? Well, you were probably filled with mimetic desire and some teenage angst or something like that. And social media only compounds the issue. As Thrive magazine wrote on school fads, social media platforms provide endless opportunities for young people to exchange ideas, to share images and links, and overall employ a significant amount of pressure on everyone to possess whatever the sought-after craze might be at this time. If all the cool girls are sharing makeup videos, then you want to start wearing makeup. If the cool guys are sharing sports highlights, then you play sports. It's not rocket science, it's just human nature. And now, each social media app seems to have its own fads too. TikTok has dance memes, Instagram has Reels, Twitter has Threads, LinkedIn has the all-too personal confessions camouflaged as humility. Facebook has, I'm not sure, anger maybe? And of course, all these fads have been socially engineered by these social media platforms to capture our attention and that of our children and that of our parents and our friends and our coworkers, etc. We're all being captured by social media. And if you haven't watched The Social Dilemma, it might be worth your time. And I fully confess to falling victim to some of these social media fads over time, both as a content creator and as a consumer. I thought, well, if everyone is enjoying it, why don't I try it? Why don't I spread the best interests in personal finance for long-term investors via social media? But after months of social media content creation, this is many years ago, I began to realize many, many problems. And the two most important are, one, I didn't really enjoy it. And two, it was a massive time suck. And when multiplied by millions of similar users, what does that time and effort and attention obtain? Well, we get thousands of computer engineers and engaging creators finding ever more efficient methods of hacking their followers' brains to sell them stuff they probably don't need. Now, is that a fad that I want to follow? Not really. But I feel completely different about writing blog posts and producing podcast episodes. I love writing, I love explaining, I love educating, I like talking into this microphone. I started with really no audience, but I kept on doing it because it was fun and I was learning and I was growing. And any influence I garnered from these projects is not really contrived. I'd say it's pretty genuine. Have I sold people stuff that they don't need? I really don't think so. I work professionally with some of the audience members as my financial planning clients. That's fantastic. To me, that's an affirmation of trust. It's an honor. And many of you out there listening, you're just tuning in to get some helpful knowledge all for free. That's pretty cool too. I don't know if I'm a good enough writer or podcaster for big time fame and fortune, but I'm good enough to educate and entertain my audience. And that's enough for me. I don't have to be a world-class videographer or a sexy TikTok dancer or the most charismatic guy on LinkedIn or something like that. As Uncle Warren Buffett famously said, investing is a no-called strike game, right? We can just sit here with a bat on our shoulders and they won't call strikes against us and we don't have the threat of getting struck out facing us in the future. And much of life is exactly the same way. You don't have to swing at opportunities simply because they are within reach. You can let them pass because more opportunities are on the way. You can wait for the sweetest pitch to pass by and then smack your own version of a home run. You don't have to follow every single fad. And investing is much the same. A small crowd starts a trend, finds some golden opportunity. I mean, literally, you can think of the California gold rush if you want to here. And then a large crowd follows them. And what the wise man does in the beginning, the fool does in the end. That's a very famous kind of investing maxim. What the wise man does in the beginning, essentially starting a trend, the fool does in the end, ending a trend. It's the same dysfunction that creates school fads, but it's manifested in a different form. Our brains are susceptible to the madness of crowds. It's true in investing. It's true in social media. It's true, in the schoolyard. The late 1990s dot-com bubble is a famous investing fad. Any company could market itself as an internet company and then seemingly 10x its valuation overnight. As of October 1999, which is before the dot-com bubble had burst, the 199 so-called internet stocks at the time had a total market cap of $450 billion, had a total prior year sales of only $21 billion, and had a total prior year's profits of negative $6.2 billion. So that's a price to sales ratio of 21, which is very, very high, and a price to earnings ratio essentially of infinity because there weren't any earnings. Now, in the short run, losing money like that might be okay for some companies. I mean, many companies do so in their early years, but in the long run, reality always wins. And the reality of losing money is that it causes businesses to fail. One infamous banking quote from 1999, that same year, is that companies come in here all the time and say, the last thing I want to do is be profitable because then I wouldn't get the valuation of an internet company. That's right. Companies would avoid profit because that's what the smart money did. In other words, the fad was to call yourself an internet company, whether you were or not, to intentionally try to lose money, which could be considered a sign of rapid growth at the time, or more realistically was probably a sign of impending doom. The third step was then to get evaluated as if rapid growth was inevitable, which is far from the truth. It doesn't happen to every single company. And then fourth, hopefully, would be to profit immensely, at least in the short term, because more investors are attracted to your pre-profit, not really growing, but should be rapidly growing company. And many investors bought that story hook, line, and sinker. And as their neighbors got rich, more investors piled in. That is mimetic desire. We are wired to do what the popular or successful or rich or influential people do. And if the story seems to make sense, and the story at the time was the internet is taking over the world, better hop on before it's too late. And by the way, look at all your neighbors who have already gotten rich off of this trend. If that is the story, and if we see the evidence before us, and if at least on the surface somehow it makes sense, then our poor monkey brains are just turned into mush and we blindly follow. Right? JP Morgan, the JP Morgan famously said, "Nothing so undermines your financial judgment as the sight of your neighbor getting rich." It's happened before. It happened to us plenty of times as kids. We might even see it happening to our children right now. It's happened to generations and generations of investors, and it will surely happen to us again. So, as they say, for example, in The Lion King, what is that, the hyena scene? Be prepared. I think that's when Scar is taking over. Be prepared. Anyway, but remember this, fads come and go, whether we follow them or not, and you never have to follow them. And that's perhaps the greatest lesson I've learned from, say, studying Warren Buffett and Charlie Munger. You don't have to swing at pitches you don't like. It's the same as your parents saying, well, if all your buddies jumped off a bridge, would you follow them? No, I guess I wouldn't. I could ignore mimetic desire in some cases, and maybe the lesson there is you can ignore mimetic desire in all cases. And if you need something to pass the time, you can go play with a fidget spinner instead. We're going to go now from the 2017 fidget spinner days. We're going to back up a few millennia to the Greeks. We're going to talk about the Cyrenaics. The Cyrenaics were an interesting bunch. Their school of philosophy, founded in the city of Cyrene, hence the name Cyrenaics, preached these two things called the skeptical epistemology and sensualist hedonism. Now, what is skeptical epistemology? I don't know, but Wikipedia tells me it's about knowing what's true, knowing what's real, and the theory of knowledge itself. Seems pretty philosophical to me. But I'm more interested in, especially in today's podcast episode, I'm more interested in this idea of sensualist hedonism, which deduces a single universal aim for all people, which is pleasure. That is the single aim. Physical pleasure is best, said the Cyrenaics, so sweet foods, a soft kiss, cool water on a hot day, but pleasure can also take a brain-only form, something like contentment, this emotion we feel. Contentment, altruism, friendship, and justice are all good, pleasurable feelings worth pursuing. But pleasures, they said, are only beneficial insofar as they don't bring pain with them. Pain, after all, is the antithesis of pleasure. And Cyrenaic leader Aristippus once wrote, "The best thing is to possess pleasures without being their slave, not to be devoid of pleasures." In other words, his motto, I suppose, or his order of operations was 1, seek out pleasure, but 2, don't let pleasures or pleasure seeking capture you, since being captive is a painful thing. And then 3, don't intentionally avoid pleasure for the fear of pain. So our brains are hardwired for pleasure seeking, and the Cyrenaics were onto something. We say yes to things in our life that feel good, especially if they're easy. And we say no to the things in our life that are painful, especially if they're hard. It's probably why we, say, hey, pass the donuts, please. But do we actually feel contentment from pleasure seeking? So this whole article was inspired basically 3 years ago exactly, I'm recording this as in August of 2025. I wrote it in August of 2022 because I was on a camping trip in the wonderful Adirondack Mountains. And as a few of us were sitting close to a campfire on a really cold night, a friend of the blog, Nikki, she leaned over and she asked us, hey, do you guys ever struggle with contentment? The feeling that what you have, is it enough? And in my mind and out loud too, I just thought, yes, absolutely. We absolutely do. And I don't think necessarily that hedonism is the answer here, just to be clear. But my first reaction to Nikki's question is that, yeah, I feel FOMO, or the fear of missing out, because simply there isn't enough time to do everything that I want to do. Our 24 hours in a day aren't enough to satiate the feeling that I could, maybe should, be doing something more. And that's despite the fact that I'm in a loving marriage, with a great career, which I absolutely love. This fun project I run on the side, this podcast, the blog, which I love. I've got a beautiful daughter and a happy dog and a wonderful wife and great friends. I have nothing to complain about. My life is great, but I still pine for more. And why? I don't know why. Why is there this kind of greedy goblin in my head who's got an appetite for gobbling up life? And now, to partially answer that question, I suppose it helps to jump from the ancient Greeks to the original Buddhists further east. According to, this is a quote from a PBS documentary about Buddhism. In Buddhism, desire and ignorance lie at the root of suffering. By desire, Buddhists refer to craving pleasure, craving material goods, and immortality, all of which are wants that can never be satisfied. All of which are wants that can never be satisfied. As a result, desiring them can only bring about suffering. Ignorance, in comparison, relates to not seeing the world as it actually is. So that's the other root of suffering, is ignorance. But the main one here, that desire for more, especially for desires that can never be satisfied, that is a root of suffering. And that brings us to the so-called hedonic treadmill, right? Hedonism, the hedonic treadmill. And the hedonic treadmill is a pillar of kind of where frugalism and the FIRE movement and financial planning, personal finance, where they all kind of meet, and where it all interacts with how we think about the world in our brains and our monkey psychology. That's where the hedonic treadmill comes in. It's also called hedonic adaptation. It describes the tendency of humans to seek pleasure, but then to adapt to that pleasure, thereby maintaining a stable level of happiness, right? You really want to get new shoes, and you get the new shoes and it makes you happy. But then you get used to the shoes, and your happiness resets to prior levels. So even though you have the thing that you thought you wanted and you had the thing that made you happy temporarily, it really was just a temporary happiness. And so while a real treadmill, you're walking on the real treadmill and it's wearing your shoes down, the hedonic treadmill wears down the pleasure that they bring. Now substitute everything else in life for the shoes that I just talked about. A new house, a new car, a new hobby. If you're searching for happiness in this manner, it's like running on a hedonic treadmill. You can try and try and try, but you won't actually get there. You'll be working hard, but essentially you'll be standing still. The new house might feel good, but then you'll get used to it. The new car might feel good momentarily, but then you'll get used to it. Over and over again, we can spend money and we can spend our energy and we can spend our time in life pursuing more, thinking it'll make us happy, but you might just be running on that hedonic treadmill. And yes, it becomes a recipe for financial hardship because you're not exactly just running in place per se. You'll be spending more and more and more, but you won't necessarily be feeling any better for it. And that's a recipe for financial hardship. So when I think about this, I now am branching over to the topic of financial contentment. Is my salary enough? Is my car enough? Is my house enough? These are all legitimate questions that most of us ask ourselves at one time or another. But I think it's important to pause and then ask, why are we asking in the first place? So as an example, let's look at the house question. Are you worried that your family is simply outgrowing the space that you have? Is this a logistics question? Because if so, it's probably just fine. But the alternative is, does your house feel small compared to that of your friends or your neighbors or your coworkers, right? The first question has a tangible endpoint. The solution is within reach. You can buy a house to meet your family's needs. And unless your family is growing infinitely, maybe you're that kind of a hedonist, unless your family is growing infinitely, you can find a house to address your concerns. The question isn't a treadmill, but a well-defined trail from point A to point B. It's less of a want and it's more of just a need. We need a bigger house to support the family. But the second question, does your house feel small compared to your friends or neighbors or coworkers? I'm not sure that one has a tangible endpoint. Much like that saying, there's always a bigger fish, there's also always a bigger house. It's a wanting feeling. It's not necessarily a needing feeling. And if you're in this position where you're comparing your houses to the others and you're keeping up to the Joneses, I only see two viable endpoints to that thought process. The first endpoint is that you build the best single house in the entire world. Or the second endpoint is that you constantly and consistently feel inferior to other houses forever. So you'll always be inferior, right? You're just a mere fish stick next to a great white shark. And the solution, therefore, I think it can't be to always feel inferior. And the solution can't be to build the best house in the world. We have to back up and reset our baseline. The solution is to train yourself to not compare in the first place, right? Comparison truly is the thief of joy. The learning curve, though, to train yourself not to compare, it's a really steep learning curve. It's really hard to do. Our Western culture, and it's bent on materialism and status, has bombarded us with the urge to compare. Just go down the highway and check out all the bumper stickers about, whose kid is going to what college and where you're an honor roll student at and all the other things. We are a society that sometimes seems to be built on materialism and comparison. But we have to learn, hard as it might be, not to assign our self-worth based on comparisons. your house, your car, your dog's status as the Kennel Club Puppy of the Month, it doesn't make you a superior or inferior person. I found this exercise once that I think is useful. I'll be honest with you. I haven't exactly followed this exercise routine myself, but the exercise is to write down what you want, to write down why you want it, then to write down why it'll make you happy, and you write down the date of when you're maybe making that particular entry. And then you rinse and repeat. Maybe it's once a month, maybe it's once a quarter, but essentially the whole exercise here is to start tracking your desire. And when enough time has elapsed, you can start to track your happiness too. And you'll start to collect real data from these real past versions of yourself. And that data might show you if you're struggling on the hedonic treadmill. Are your desires from the past, are they based on comparisons to others? Or are they based on real material needs in your life? Do your desires turn into actions? And did that action actually lead you to more happiness? Or did it lead to dissatisfaction and more desire? Did your happiness or unhappiness persist? Was it fleeting? Did you hedonically adapt to more happiness? I mean, humans have struggled with this stuff forever. The Cyrenaics were trying to figure it out 2,400 years ago. And then Buddha had them beat by about 150 years. He was trying to figure out 2,600 years ago. Seeking contentment is part of the human condition. In fact, this discontent is probably a simple evolutionary side effect. Who's more likely to survive? The animal who's content to sit on his butt, or the animal who's constantly seeking more and more and more? And while desire seeking might be natural, at least certainly part of natural selection, most of you and most of us are beyond the, ape on the savannah days. We no longer need the more to survive. It doesn't take a sensual hedonist to remind you to eat, drink, and be merry, for, as Dave Matthews says, for tomorrow we die. And then last, I want to dive into kind of where the rubber meets the road. This is a combination of what's going on in your head, but also the nuts and bolts of how we put together an actual financial plan. I want to talk the 6 components of behavioral loss tolerance. BLT. Yes, my favorite BLT is a sandwich, but my second favorite BLT is behavioral loss tolerance. We've talked a lot on the podcast and on the blog before about the fact that each of us has a willingness and ability and need to take on risk. Those 3 words, willingness, ability, and need. More specifically, the ability and the need part, those are objective and numerical. Your need to take risk relates to the amount of objective investment growth required to meet your financial goals. And then your ability to take risk is based on your capacity to withstand and recover from losses. Temporary losses, permanent losses. So whereas need is a function of required growth, ability is a function of recovery from loss. And again, those are based on hard numbers. But your willingness to take on risk is subjective. It's really a matter of feelings and psychology, purely mental. How will you react to the higher volatility that comes with high risk investments? Are you willing to stomach losses? So today I want to dive deeper into that willingness to take risks. And really the more technical term for the willingness to take risk is behavioral loss tolerance, BLT, behavioral loss tolerance. And specifically, I'm going to focus right now on the 6 agreed upon components of an investor's behavioral loss tolerance, along with a bunch of questions that you can ask yourself to start to figure out where you lie on this BLT, behavioral loss tolerance spectrum. The first of the 6 pillars is risk tolerance. Risk tolerance describes your readiness to engage in financial behaviors with uncertain outcomes and potential for loss. So it typically measures how much loss you might be comfortable facing before feeling the need to exit an investment or reduce your exposure to future losses. Risk tolerance is usually assessed via a questionnaire. So some typical risk tolerance questions might include, how many years do you plan to keep your money invested before needing it? How do you feel about short-term losses in exchange for long-term growth? If your portfolio dropped 20% in a year, what would you do? Would you sell everything? Would you sell some to reduce risk? Would you hold steady? Or would you buy more while it's down? Another question, would you rather gain 4% per year with no volatility or have a 50-50 chance of gaining 12% or losing 5%, 50-50 chance? So guaranteed 4% or a 50-50 chance between gaining 12 or losing 5. The next question, how often do you check your investment account balances? How often do you log in? How often do you check those balances? If your $100,000 portfolio dropped to $85,000 over a 6-month time span, what would you most likely do? And then the last one, imagine 2 investments. Which would you choose from? Investment A with an expected return of 6% and a worst year of minus 10%, or investment B with an expected return of 10%, but a worst year of minus 30%. So again, all of those are risk tolerance questions, and risk tolerance is your It's your readiness to engage in financial behaviors with uncertain outcomes and potential for loss. But the second now of the 6 pillars is risk preference, which represents your general desire to take more or less risk. This is where you might describe your personal attitudes and priorities about risks. Would you rather preserve your money, even if it means lower growth? Do you value compounding your money, even if it means occasional losses? What's your first instinct when you think about investing? To seek growth or to prevent loss? How do you describe yourself as an investor on a spectrum from ultra conservative to ultra aggressive? A good question would be, would you rather own a slow and steady bond fund with minimal risk, a high growth stock fund that might be volatile along the way, or something in between, a diversified portfolio of stocks and bonds? Those kind of answers shed a lot of light about your risk preference. The third pillar, financial knowledge. Financial knowledge represents your financial education and training. I love financial knowledge. An investment in knowledge pays the best interest, right? A strong foundation in financial knowledge helps interpret and emotionally process what's happening in your personal finances, in your financial plan, in your portfolio. I would wager, and I'm not alone, that people with stronger financial knowledge tend to better understand that short-term losses are normal, know historical returns and risks of different asset classes, have more realistic expectations for investment returns, feel more in control of their investment decisions, and they avoid panicking when markets drop. In contrast, someone with lesser or lower financial knowledge, they might think that a 10% loss from the stock market is unusual or catastrophic. They might confuse short-term volatility with long-term failure. They might always believe that they need to do something during downturns. They need to take action. They need to go out and do something when markets are choppy. They might overestimate the safety of cash or fixed income. Financial knowledge doesn't guarantee high behavioral loss tolerance, but it certainly can raise someone's ceiling by helping them stay rational and stay grounded when markets test their nerves. The fourth pillar is investing experience, which describes your time and experiences in the world of investing. Specifically, and maybe the way worth pointing out and comparing and contrasting, is that someone can have substantial financial knowledge, but have limited financial experience, and vice versa. Investing experience reflects how much real-world exposure someone has to the ups and downs of markets through actually putting their money at risk. It's the lived version of financial knowledge. I remember during one of my first commercial flights, there was, at the time, what I thought was pretty bad turbulence. Only in retrospect did I realize it was relatively minor turbulence. And that's kind of the point. There's this relatively minor turbulence scared the heck out of me. I was white knuckle gripping the armrests in between the chairs. And part of that is because I had no experience. I had nothing to judge turbulence against. Only in time did I realize that, first off, turbulence is pretty normal, and that what I experienced on that flight was really just a drop in the bucket. And there is a similarity in investing. Experience brings emotional muscle memory with it, right? Someone who's seen losses, who's held steady and watched a recovery, they have a deeper and calmer relationship with risk. And I contrast that with someone who's new to investing. Even if they've read all the right books, they haven't felt the stomach drop of a bear market or the thrill of a bull market. Their risk tolerance is pretty untested. And the questions here are straightforward. How long have you been investing? What was your first market downturn and how did you handle it? Have you ever made a decision with your investments that you later regretted? Do you remember what you did in the dot-com bubble, or in 2008, or in 2020 with COVID, or in 2022 when the interest rate spikes? Do you have scar tissue? And that's really what investing experience, this fourth pillar, is all about, is our scar tissue from past experiences. The fifth pillar is risk perception. It's a subjective assessment of the riskiness or lack thereof of investing. It's typically influenced by social interactions, by the media, by our understanding of financial concepts. Two people can look at the same investment and see very different things. This is an interesting one because we see this all the time, or at least I see this all the time, right? A lot of people like to quote Vanguard index funds. So if I put VOO, the S&P 500 index fund, or VTI, which I think is the total market, the total US stock market index fund, two people can look at those two ETFs, and one sees a low risk, very diversified index fund. Another person would say, but that's all stocks, and all stocks by nature is pretty risky. So two people can look at the same investment and see very different things. Two people can look at the same market behavior, say a 10% correction. One person sees a temporary dip and it's a buying opportunity. A second person sees it as a sign to sell and to sell quickly because they just quote unquote lost 10% of their money. So this risk perception isn't always based on facts or statistics. It's truly based on a subjective perception in an individual investor's mind of what's happening and then what might happen next. Risk perception is often shaped by recent market events, right? Recency bias, by media narratives, by personal or family history. If someone says, my parents lost everything in 2008, that's going to have a really big effect on their risk perception. It can be based on cultural or generational mindsets. When I hear someone say, the stock market is basically just a casino, to me, that's them speaking out loud part of their risk perception. And some open-ended questions to consider to evaluate your own or evaluate someone else's risk perception. It could be something like, what does the word risk mean to you? Do you see investing as a positive thing? Do you see investing as a way to grow wealth? Or do you see investing as something you really need to be cautious about? What concerns do you have when markets go down? The goal is to uncover how someone frames risk, not just how someone reacts to it. And then the sixth, the final pillar is risk composure. Risk composure measures your actual behavior during difficult market conditions, your ability to stay calm and stick with your investment plan when markets get choppy. It reflects your emotional steadiness in the moment, especially during volatility, uncertainty, or loss. In fact, some financial experts, I'm not sure I'm one of them, but some financial experts recommend that you intentionally stay conservative in your investment portfolio until you've lived through a market crash. As you can't truly know your risk composure, this sixth pillar, you can't truly know it until you've lived through it. So people with high risk composure, they tend to stay invested throughout bear markets. They tend to avoid panic selling or reactionary moves. They understand that downturns are part of the process. They tend to seek counsel or reassurance instead of immediately taking action. And just in general, I would say they tend to stay calmer even when markets are more chaotic. Whereas people with low risk composure, they tend to sell quickly during drawdowns, frequently change strategies or reallocate. This is a really important one because there are plenty of people out there who I've interacted with who say, no, it's not that I want to avoid investing altogether. It's just that, now that NVIDIA is doing well, I really want to throw 10% of my money in NVIDIA. Now that Bitcoin is doing well, I want to throw money at Bitcoin. And then, NVIDIA's not doing well anymore. Yeah, I still want to keep my money in the market, but now I'm going to sell all my NVIDIA now that it's down. And now I'm going to go put that money into an index fund just to diversify. So people who frequently change strategies, people who frequently reallocate, that's a sign of low risk composure. Some other signs include just feeling emotionally overwhelmed during market stress and needing frequent hand-holding, very, very frequent hand-holding because they're letting the media or short-term market behavior really affect what's going on in their brain. Some good questions to ask yourself to gauge your risk composure include, have you ever sold investments out of fear or stress? When markets fall, how often do you check your investing accounts? Do you feel pressure to do something? You got to do something when the market is down. Now, the hard part about all of this, and I should say that wraps up our 6 pillars. Again, they were risk composure, risk perception, investing experience, financial knowledge, risk preference, and risk tolerance. But now moving on, the hard part about all this, in my opinion, is transitioning from the 6 pillars, from the sample questions that I mentioned after each pillar, your answers to those questions, to then getting to an appropriate asset allocation for you, right? At the end of the day, this is about understanding your behavioral loss tolerance so that you can build a portfolio that reflects how you feel about investing in the markets and risk and returns and all that. And there really is no perfect approach. But I really do think that your answers to the questions I was asking before, and I think where you fit into this framework of these 6 pillars can really help drive towards a better or more accurate asset allocation for you. And I really think of this problem, if you will, almost like a spectrum from white to black. And maybe you've seen it before, whether at like a paint store or just for some reason online, this interesting illustration of just purest white to the deepest, darkest black with many, many different shades of gray in between. I know that most people, most of us listening, we're going to end up somewhere in the gray. We're all going to be various shades of gray. But there is a really big difference between dark, dark gray, so dark it's almost black, and light, light gray, so light it's almost white. Yeah, sure, they're both gray, but they're very, very different. I wrote in an article that I'll link in the show notes, an article called Pedal to the Metal, that similarly, there's not really a big difference. If you're in a 55 mile an hour zone, and sure, if you're going 57, technically you're speeding, and if you're going 53 miles an hour, technically you're not. But there really isn't a big difference at all between driving 53 and 57 miles an hour. It's just the most minute, small differences in shades of gray. And similarly, in investing, I don't really see that big of a difference between a 60-40 portfolio and a 55-45 portfolio. If the second one, because it's a little more conservative, makes you feel better, that's fine. But in terms of results and in terms of actual risk and reward of the portfolio, there's just a very, very small difference. And I'm not sure that any sort of risk questionnaire or behavioral loss tolerance questionnaire is going to help us draw a distinction there. But there is a really big difference between driving 70 miles an hour and driving 50 miles an hour. Like those are two different things. And there is a big difference between a 70-30 portfolio and a 50-50 portfolio. And while they're both certainly shades of gray, I think that your behavioral loss tolerance and that kind of questionnaire really can draw a distinction between those shades, really can help us make a determination of to whether you'd be more appropriate in a 70-30 portfolio or in a 50-50 portfolio. So in that way, behavioral loss tolerance and its 6 subcomponents, they aren't going to give you a perfect answer of how to build your portfolio according to your unique risk level. But directionally, they're terrific. And I would recommend that any investor, new or old, understand where their answers lie and kind of where they map onto the framework of the 6 pillars of behavioral loss tolerance. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. So without further ado now, let's talk more about Your Brain on Money with Hanna Horvath. Again, Hanna is a CFP, Certified Financial Planner. She's the managing editor at Bankrate, and she writes a lot of cool stuff about Your Brain on Money over at her Substack newsletter called Your Brain on Money. So without further ado, here's Hanna. Hanna, I'm excited to dive into some interesting money psychology topics with you today. And I want to start with this juicy one, simply because, most of my audience, it's kind of cool how you can get stats on who your audience is from some of these podcast players. And I know that most of my audience is maybe 40s or 50s thinking about retirement. So the question is, do you think people get more or less rational about money as they age, and why?
Oh, I don't want to say more or less, but I don't think you get more rational just as you get older. I feel like one of the big kind of takeaways of money psychology is that more information doesn't always equal more action. Obviously, the older you are, you've had more experiences, you've had more access to financial knowledge, maybe you've handled money more, but unless you've kind of taken the time to unpack your financial behaviors, you can wind up repeating the exact same money mistakes over and over again for decades. And the pre-retirement period into retirement period especially, I think is a very fraught period that's wrapped up in a lot of emotion and just a very kind of high stress period potentially because you're making a huge life transition. So I think just those phases of your life naturally lends itself to less rational behavior.
Mm-hmm. You mentioned something there just about repeating the same mistakes over and over and over again. Is that just a function of just not being aware that there's a mistake in the first place? Or is it almost like when you hear about people who have, bad habits, we all have some bad habits. And when I think about my bad habits, I know it's a bad habit. And yet I still sometimes repeat that habit over and over again. So when it comes to money, is it easy to fit into one of those 2 boxes, or is there a little bit of both?
I would say it's definitely both. I think definitely the first piece is so much of our money behaviors. I think we just don't realize how much of our unconscious, I call them money scripts, but kind of things happening under the surface that are causing our financial behavior. So that's kind of the first piece. But I do agree. I think a lot of people are at least somewhat aware of their bad habits, and money habits could be part of that. And of course, if you haven't thought through sustainable ways to improve those habits, you're going to keep making them. So there is a little bit of conscious effort involved there.
Remind us again, what do you mean by money script? What's an example of that?
Yeah, so I think people have a tendency to think of money as this very quantitative, robotic, tangible thing, when really it is so emotional and so personal to us. And we have money scripts, which are these kind of underlying beliefs and emotions we have about money. And they are often formed initially in childhood, but they are shaped throughout your life experiences. And I describe it almost like a computer where they're running automatically in the background. They influence a lot of your behavior, your financial behavior. And a lot of times we have no idea that's even happening. It's very interesting in that it has a huge impact on our wealth over time. And yet I think a lot of people aren't fully aware of just how much our emotions and also these unconscious scripts affect our money decisions.
I'm listening to your answer and like part of my brain is going, well, I don't have those. But then, of course, part of your explanation is that they're going on under the surface. They're unconscious or subconscious, and you're not even aware of what's going on. So it's kind of that like, well, you don't know what you don't know. So how can someone start to untangle, if that makes sense? How can someone discover what their unconscious money scripts even are?
Yeah, so the first is to just think about what your financial habits are, good or bad, how you handle money, and think about kind of what comes up, like what emotions come up. And then think about what were kind of some early experiences you had with money, with, your parents have a big influence on how you handle money later in life. And I'm not just talking about the way that they spent and saved, I'm talking about the way they talked about money. And that, even as a young child, it can be very impressionable on how you kind of perceive things down the road. So just taking some time to sort of reflect on all of that can help you understand, oh, this is why I feel anxious when I check my bank account. This is why I kind of avoid making a budget. And again, just really bringing awareness is sort of the first step. And it really is a first step to kind of building better, longer, sustainable habits. But something I did want to touch on is I think a really common fallacy is that you and we know a lot about money, right? We have a lot of financial knowledge. And what'll happen is when we make, or at least I'll speak for myself, when I make a money mistake, I tend to beat myself up because I'm like, oh, I know all this information. Why am I still making these mistakes? And that's why it's so important to understand these kind of unconscious things that are running in the background, because then you can have a little bit more self-compassion and understand, it's my brain, and, it maybe will empower you to kind of take more action.
Yeah, that is really interesting. And going back to, I think you mentioned this term today. I know you mentioned it in your writing, this term of emotional discipline. Mm-hmm. And so I think about like, okay, like I know the dictionary definitions of those words, but sometimes in my own life, right, whether it's getting frustrated over something I did wrong or having a hard conversation with my wife, I think about applying that word, that term, emotional discipline there. But how does that emotional discipline, what does it really mean, maybe in a psychological context? And then how do we apply it to our finances? Like, what does that look like in practice?
Yeah, so emotional discipline isn't controlling your emotions completely, because we're never going to be perfect. There's always going to be moments where our emotions get the best of us. But it's just understanding your emotions and the place that they're coming from, because emotions are data. They're pointing you in a direction of some deep-seated feelings or ideas that you have, or even part of how you perceive yourself or you want someone else to perceive you. The same goes for money. And again, it goes back to this idea where I think a lot of people think of money as not emotional. And so I don't think they always realize that there are emotions attached to a lot of our financial behaviors. So I think it's really important to start to, one, obviously unpack the emotions, but then also bring a little bit of, I always say, like, just build in some frameworks where you can just build a little gap between the emotion and the action. I'm someone, for example, who used to very anxiously check my bank account multiple times a day. And it was really coming from a place of worrying that I was going to lose all my money, and this feeling of scarcity. And once I was able to unpack that, I was able to understand, okay, this is this emotion that's coming up and is driving me to do this financial behavior. I was able to then kind of break that bad habit by bringing awareness to that.
You said putting a little gap in between the emotion and the action. I mean, is that literally a time gap, or is it some other sort of gap?
It could be, yes, it can literally be a gap. And it could be like 5 seconds. The example I always give is like to not, for example, save your credit card information in your computer. So, the literal like 10 seconds it takes you to get up and go get your credit card across the room, that can sometimes be enough time to slow down your thinking and sort of be able to make a more intentional decision. We have 2 decision-making systems happening in our brain. And this is something that was kind of discovered and then popularized by Daniel Kahneman in that book, Thinking Fast and Slow. We have the fast emotional system that makes those very quick split second decisions, and then the slow analytical system that is great for long-term planning. And these systems work together, and what you want to do to bring more kind of discipline into your life is to kind of create that gap so that, slower system can take back control instead of just making those impulsive choices.
Interesting. Yeah. Danny Kahneman, often cited here on the podcast and on the blog. You just mentioned some of your own anxiety in your personal finances. And I think about the emails that I get, and right, a lot of them tend to be retirement focused in some way, retirement planning focused. And there seems to be a lot of anxiety about making money decisions, including from people who, like from the outside looking in, the term I've used before is winning the game. There's some people out there who have won the game by any sort of quantitative measuring stick. They've won. And yet they still have a lot of emotion tied up with the act of retirement, the act of planning for retirement. So I'm just curious, like, from your point of view, I'm not sure how to frame this question exactly, but it's like, what role does anxiety play in money decisions, in financial planning, specifically if you have any experience with this around retirement?
Well, first of all, money anxiety is very common, and it does not matter how much money you have, what your net worth is, you can experience money anxiety. And I think, like I was saying earlier in our conversation, for retirement specifically, you have spent decades likely preparing for this event. It's a big life change, not only in like what you're doing every day, you're hypothetically not working anymore, but also just how you're perceiving yourself. And so it's a big identity shift. So that can be scary for a lot of people and very anxiety inducing. Even if you're someone that is like, quote unquote, looking forward to retirement, you can still feel some anxiety there. And then I think on a larger scale, there's just tons of economic uncertainty right now happening in the macro environment, which can lead to a lot of anxiety. Because again, our brains, a lot of what anxiety is this desire to want to control your situation. And so much of what we're reading on in the economy, we can't control. But our brains want to have that control, so we get anxious. Same with retirement. I mean, there's so many variables that you can plan for in retirement, but things happen, life happens. It's impossible to predict anything with certainty. So again, I think all of that uncertainty wrapped up in retirement can drive a lot of that financial anxiety. And I think that's why a lot of people feel that, even if they've, like you said, have kind of made it and have those kind of numbers and all that figured out.
I do want to come back when you talk about certainty and uncertainty, and volatility is a word that I think of. And I think that it's kind of funny. This industry, my industry, sometimes, I don't want to use the word prey, but maybe that's the best word to use. We prey on the fear of volatility, or financial professionals, I should say, some of them prey on the fear of volatility, and they prey on that desire for certainty, and therefore push products that make certain promises of certainty. We can come back to that one, because one thing you just said there, Hanna, had to do with identity, retirement as an identity shift. And yeah, I think to myself, well, like, the markets are somewhat out of your control. The macro economy is somewhat out of your control. But for a lot of retirees, their identity, well, if your identity isn't within your control, then what is? Yeah. And yet there's this massive identity shift. So like, okay, obviously from the outside looking in, I was a worker, now I'm a retiree. My identity is shifted. Is it more complex than that? And I guess really the underlying question is, what can we do to try to make sure that this big shift in identity doesn't produce this anxiety, doesn't derail our long-term plans?
Yeah. So I think when most people plan for retirement, they think of a number. You can run a very sophisticated calculation and get a number, which is obviously important. But what I think a lot of people might not take enough time to do is think, what do I want my retirement to look like? What do I want my life to look like? What do I care about? And I always say money is a tool to give you the life that you want. But if you have not clarified what you care about, what you value, it's often going to lead to discontent, because you'll end up spending money on things that you don't care about. And so I think that happens in retirement, where people are very fixated on a numerical goal, and then they get there and then they retire, and they don't know how to use their money in a way that will bring them satisfaction. Like a small example that I can think of is, maybe you're someone who really values travel and freedom, and yet you're saving up to buy a house in retirement. You can see the disconnect there. So I think, again, like making sure that your financial goals, retirement and in retirement, lines up with how you actually want to live your life. I think that'll help drive a lot of the purpose that you got from work. But again, it is, as you said, it is a big identity shift. I think, especially in America, people derive a lot of their purpose from work. So I think, that's kind of like a separate conversation, but really trying to find a way to think about like, what do I want this chapter of my life to look like? Where am I going to derive my purpose from?
Do you have any examples either from just, I don't know, interviews you've done, articles you've written, people you've spoken to about how they replace that purpose in retirement?
My impression based on, just talking to people and researching that is, I feel like the latter stage of your life tends to be a period of kind of reflection and looking back and wanting to give back and sort of impart wisdom onto earlier generations. And that can look in many different ways. That could be helping to raise grandkids. That could be doing some sort of teaching or educational component. Even just like hobbies and having that sense of community can really drive a lot of purpose, because work also was a place of social connection, or is a place of social connection for a lot of people. So again, it comes back to understanding your values. If you're somebody who strongly values community or strongly values family, finding a way to make sure that you are working that into your retirement plan, and especially not following what other people or social media is telling you should be doing in retirement, because that leads to a misalignment and then often leads to discontent.
Here's a quick ad, and then we'll get back to the show. You probably know that I love listener-inspired content, but this is my first listener-inspired advertisement. Frank asked me, in short, Jesse, is there a best time to start working with you as a client? And the short answer is yes. There are two ideal times. One is at the beginning of a new year for probably some pretty obvious reasons, but the second one is right about now, September and October. It's the perfect time for year-end tax planning to ensure you find the correct balance of Roth conversions, tax gain or tax loss harvesting, making charitable gifts, spreading out any portfolio changes over multiple tax years, or whatever other tax dials we can turn for you. Working backward from the December 31st tax deadline, the time to start those initial conversations is right now, August, September, maybe into early October. You want to give yourself and us enough runway to make sure we get this right for you. So if you're interested in starting a conversation with me and my colleagues, you can go to bestinterest.blog/work and fill out the form there. Again, that's on my blog on the Work with Jesse page. The address is bestinterest.blog/work and fill out the form. I think we were just talking about people maybe feeling a fear of running out of money in retirement. And that's something that I hear a lot of, is like one of these overarching fears is just, can I pull the retirement trigger today? Yeah. Can I spend this much money per year? Can I live this desired lifestyle and feel positive that I won't run out of money? Yeah. So obviously that in itself, I mean, I totally get why that's anxiety inducing, but maybe let's start with that. I do want to pivot back to the idea of volatility. But again, what can people do other than just kind of pounding people and people pounding themselves over the head with numbers, Monte Carlo analysis and X% withdrawal rule? What can people actually do, maybe other than bashing themselves over the head with numbers, that will make them feel more comfortable to pull that retirement trigger?
The first is understanding that you are not going to have all the answers when you retire. You can have, like I was saying early in the conversation, you can have the perfect retirement plan and things can happen. Things can go sideways. It's life. And so I think getting comfortable with that idea of uncertainty, but also, maybe doing a pre-mortem, walk through how it'll feel or what a contingency plan is if this XYZ happens. I think that just even that visualization exercise gives people at least a sense of control of like, okay, my plan is, it's all about resilience, right? Like my plan is resilient. It can withstand these kind of different contingencies. So instead of if something does happen, you have sort of this script and you feel more confident instead of having to rely on like willpower or discipline or anything like that. And to a point that you made earlier, fear is a very powerful motivator. I think that's why a lot of the financial advice that you see online is very fear-driven. Mm-hmm. They're fear-driven because it often drives people to take action because it makes people anxious. And so I think the other big thing, and this is no secret, this has been repeated like probably hundreds of times, but like knowing when to stay the course. When you have a plan, feeling confident in your plan and, not straying from the path. And as I was saying before, I think especially in today's kind of world, especially the rise of like, social media and all of that is, I think when there is a environment where there's a lot of fear, there will be people that will step in and try to kind of sell you something. Because again, people just want answers. They often with money, they don't want to deal with it. It's too stressful for them. So they're just looking for someone to tell them what to do. Well, I think getting that advice from a financial advisor is helpful. If there is somebody saying, I have all the answers, that's a huge red flag. So like knowing how to discern does this actually make sense for me? Or is this person kind of like selling me snake oil?
Yeah, that discerning ability in and of itself is something that I find people have to develop over time. It's something that I'll share with my audience is like, even now, like I've been really immersed in this stuff for probably 10 years. And there's still something that comes up on a weekly basis where I'm like, oh, I've never encountered that. Maybe it's a technical topic. I've never encountered that specific technical interaction in the tax code before. And so I have to go and look it up. And similarly, I think especially whether it's DIYers, people in the FIRE movement, people maybe dipping their toe in the retirement planning waters, like there are going to be plenty of things that you don't know off the top of your head. Yeah. But it's important to develop this sense for, okay, I think there might be some sort of weird interaction here. Let me dig deeper. And similarly, for people maybe who are contemplating reaching out to a financial planner, a financial advisor, someone with a title like that, whether they do real work or not, is trying to develop a little bit of discernment for like, okay, what exactly will this person do for me? What are they selling? That kind of thing. You mentioned something there, Hanna, having to do with like preparing yourself for the inevitability that during your retirement, a market may crash, or you might go through some hard times in your financial plan. And this is a little bit of a shameless plug. I love writing about fire drills, like those things that we did in elementary school, because it's like, okay, 4 or 6 or 8 times a year in the middle of class, okay, now there are these loud, scary sounds. And over time, you were taught to just stand up, get in a line, go to the nearest exit, go outside, and that's that. And the reason why, of course, is that when there's a real fire, the last thing they want are hundreds of kids panicking and not knowing what to do. Like, what a terrible, tragic situation. But I encourage my readers, my listeners, just to do the same thing with your financial plan. It's like run a fire drill, if you will, for your financial plan, and ask yourself during the good times, the calm times, you can ask yourself, what would happen if? How would I react if? How would the numbers look if the market dropped by 30%? Maybe what would I change in my plan? Because the last thing we want is for that quote unquote fire to happen, like a market crash. And then we say, I've never thought about this before. I didn't think it could possibly happen. My emotions are high. My fight or flight brain is saying, flee, flee, flee. And yet here I am supposed to also be making rational money decisions right now. I imagine that's got to be a recipe for disaster.
Yeah, I mean, in those moments, your brain, like I said, it's a very emotional time. It's going to be very difficult to think rationally and rely on discipline alone. And so that's why I love the idea of a fire drill. And also, I'll just say, I don't think a lot of people have gone through the exercise of what it will actually feel like for that to happen. I'm on the younger kind of end of the millennial cohort. Most of our lives, we've been in a bull run. We really have not experienced what it's like for our portfolios to drop 30%. Maybe we had a little blip back in April, but it recovered. And now it's like, I think a lot of people have not done the exercise of like, how am I going to feel if I open up my account and it's 30% less than it is right now? And that's why I think it's really important to like go through like what you're going to be feeling and then go through kind of, okay, what is the game plan? Because it's like almost like you said, it's like a fire drill. It's like practicing, because when that time, or if that time actually comes, you don't want to rely just kind of on your in the moment thinking, because it's going to be so stressed out and so anxious.
Because it's not like the 30% drop is going to occur in a vacuum. It's going to occur with this overlay of macroeconomic news, or this overlay of political drama, this overlay of a war just broke off in this area. And so in some sense, you're going to say like, well, the sky seems to be falling in a real world point of view. Oh, and also my portfolio is down 30%. And that's where, I mean, you mentioned April there, Hanna. Like I had clients in April basically saying, well, until this whole tariff thing settles out, doesn't it make sense just to go to cash? I'm down 10% over the last few days. Let's just go to cash and wait for it all to settle out. And in some ways, as a rational response, like I totally get why someone would think that. It's just a matter of, if you look at market history and how hard it is to make that decision then to get back into the market, that's where the rubber meets the road, and it becomes a really scary proposition to act like that. But left to our own devices, it's like, of course, this roller coaster is getting really scary, and I want to jump off the roller coaster. That's totally human.
And it's especially, the roller coaster is also, like you said, it's coupled with these macroeconomic factors, and it's also coupled with every headline, every social media post, like ringing the alarm bells. I always say, during these periods, like back in April, try to stay off Twitter or X. try to avoid, at least for a couple of days, the financial headlines until things die down. However, don't avoid looking at your portfolio. I've noticed that's like a kind of common tendency when this kind of stuff happens, but avoidance only can increase anxiety. So I actually encourage people, if there's a downturn happening, to look, but kind of to get that context, to also like practice, like, okay, this is how I'm feeling. Like, information is really power in these scenarios. So it's important to just kind of be aware of what's going on.
You mentioned a story much earlier where at one point in life you said you were checking your bank account like multiple times a day, and that was maybe a function of some anxiety you were feeling. So, but going back to this most recent thing that you just said about you should check your portfolio. Don't avoid the portfolio. How does someone find that Goldilocks zone between, well, I don't want to avoid my accounts altogether, but I probably also don't want to check them multiple times a day?
Yeah. So I fell into the anxious camp, and, checking your accounts multiple times a day, I hope you're not doing it. If you're doing it, the numbers don't change too much.
Right.
For me, it was really setting time. So just being deliberate, it's like every Friday for 30 minutes, I'm going to go through my accounts. I'm going to go through my spending, update my budget. That's like my money time. And I try to do it in a time of week where I'm not, Monday through Wednesday, you're stressed. It's the beginning of the week. You have a lot of things going on. So I try to do it towards the end of the week where like the stress is a little bit lower. It doesn't feel like something that's like just to check off my to-do list. It feels like something a little bit more intentional. And when I do start to feel money anxiety throughout the week, I can say, okay, I'm just going to deal with this on Friday. And it's almost like I can just punt all that anxiety off kind of to that period of time. And that it's a similar solution for someone who is avoidant, where it's like, okay, this is your one time. You don't have to worry about checking it any of the other times, just like this one point during the week is kind of your time to go through it. And so I think like scheduling that can make it feel less scary and more intentional.
Yeah, that makes sense. I want to go back to that volatility versus certainty topic again, because I'm thinking to myself, like, volatility is both this challenging thing that we all have to deal with when it comes to markets going up and down, our accounts going up and down, checking our accounts too much maybe and seeing them going up and down. But at the same time, a investment strategy with zero volatility is probably either too good to be true or there's simply no return, right? There's no risk involved and therefore there's no return. So how can someone, and again, I tend to think through the eyes of a retiree, but how can someone kind of reframe their relationship with volatility, not to see it as this purely negative thing, because I do think it has a negative connotation, but instead to maybe say, well, it's two sides of the coin, both good and bad?
It comes down to what you're comfortable with, obviously, but also like what your goals are and what you want your money to do. And so obviously, if you are a pre-retiree, you're in a very different stage of life than someone who just graduated college and is starting the workforce. So I think just like getting a really good understanding of where you're at in life, what you want your money to do for you. There's all the kind of basic advice, like make sure everything is diversified, pay attention to like expense ratios, things like that, just to kind of keep more of your money in your pocket. But it is really just kind of going back to this level of, okay, there are going to be things in my life and my portfolio that are uncertain, but they could have those kind of higher returns. And I tend to believe that building wealth is unsexy a lot of the time and slow and boring, and that's good. That's the kind of lack of volatility that you should be looking for, is those kind of tried and true things that you almost set it and forget it. Again, well, one, that removes a lot of the decision making out of your investments, but is just also easy or cognitively to deal with. This goes back to like in today's world, I feel like so much of what we see pushed online is these like get rich quick overnight, potentially high reward, but very high risk. And again, social media rewards those people that are like making $1 million overnight, but they're not amplifying the stories of people losing all their money as well. So I think anything that has been vetted, tested, and is tried and true is what I always stick to. And again, that makes me feel comfortable with the volatility.
The title here, Personal Finance for Long-Term Investors. Pretty boring title. The other option that I was noodling around in my head was Don't Be an Idiot and Get Really Rich Really Quick Like Me podcast. But that one just didn't seem to work for my brand very well. No, I'm just kidding. I want to give a shout out to all the DIY investors. A really big portion of my audience are DIY investors. And something that just through conversations, like kind of emails back and forth with some of my audience, I know there can be one of the kind of psychological or anxiety inducing feelings is that, hey, all the good things that might happen in my financial future are on my shoulders, but also all the bad things or mistakes that might happen in my financial future, they're also on my shoulders. So I'm just thinking to myself, any tips for the people out there who just, whether it's in finances or in some other area of life, they choose to DIY things and therefore, they kind of have to live with all the consequences, good or bad. And that in itself can be anxiety inducing. Any thoughts on that?
Yeah. And I'll start by saying there's nothing inherently wrong with DIY investing. I think there's actually like a lot of benefit for some people. For example, like I'm someone who likes to feel like I have a lot of control over my finances. And if you're that type of person, I think DIY investing is great. But that being said, I think what happens, with any sort of money decision, we internalize so much of it. And we have a tendency to take ownership over the wins and then also feel bad about the losses, when really it's important to be aware of just all the forces. And I write about this a lot in my newsletter, all of the external forces that are happening around you. There's obviously a lot of internal work you can do to understand yourself and your biases, but there's also so much happening around us. I always tell people there are companies spending millions and millions of dollars to get you to spend your money on them. And you alone as one person with one brain, it is very hard to work against these companies that, again, are spending millions of dollars to kind of psychologically manipulate you in a certain direction. So have a little grace on yourself. Again, if I'm assuming, if you are someone that is DIY investing, you have a lot of deep knowledge of investing and kind of the basics of the blueprint for success, I'll say. So as long as you have that foundation and you are building on that, I think you should have a little self-compassion for things that are often outside of your control. If you take like the greatest investors of our time, like Warren Buffett, all of that, they all understood, one thing, which is that successful long-term investing is so much more about managing yourself than actually managing your portfolio. Understanding like compound interest and diversification is pretty basic to understand, but the psychology of like patience and managing your emotions is what is so difficult. And I think what separates great investors from not great investors. And so I think when you are able to master the psychology behind that, the math sort of, takes care of itself.
Awesome. Yeah, I think of that word temperament that Warren Buffett uses a lot in his writings. And speaking of writings, I know, Hanna, you write a newsletter, and I think that's kind of you're right now this big project that you're working on that's really growing and a great way for people to hear more, read more of what you have to say. So can you tell us a little bit more about that newsletter and how our listeners can go find your work?
Yes. So I have a Substack called Your Brain on Money, and I have lots of content about money psychology, but I cover kind of what's happening in the news. And then I also do kind of deep dives about money psychology in the context of cultural and social issues, and really just try to unpack why we make the money decisions that we make. So if you're interested in that, you should definitely subscribe. It's on Substack.
Awesome. It's a great newsletter, and we will throw the link in the show notes. Listeners, Hanna Horvath, thank you for joining us today on Personal Finance for Long-Term Investors.
Thank you.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.